What's up, class? Today we're going to be cracking codes and creating the financial freedom that you want for your life. I need you to take a lot of notes. This took me a little minute to put together, but this is a continuation. Okay, we're literally mapping out an individual's life. We started at the age of 54 with 135,000 of debt. Now we're at zero, or hypothetically close to zero, right? Pretty much debt free. Income's up, income increased, expenses decreased, cash flow went up, credit score built, right? We built our capital, okay? Our line of credit has increased, hypothetically, all right? So we are basically satisfying all of the things that velocity banking says that it does, okay? The concept itself. Now we're just putting the pieces together. The next step in an individual's financial journey is creating financial freedom, creating wealth, leaving a legacy behind for the family. So in this scenario, we are about 56, almost 57 years old. As a woman, okay? And I am going to display exactly how we establish a tax-free bank using the bank's money, implementing the velocity banking strategy. So what we're doing is we're combining velocity banking and infinite banking together. All right. Hope you enjoy this. This is, you know, this gets me like, this gets me excited. This gets me pumped up. I don't know how to contain myself, so I have to put it on the board. This is my brain when I'm looking at your finances. I'm like, all right, you know, we're gonna do this, I'm gonna do that, I'm gonna do this. So here we go. Income, 5K, expenses, 2K, cash flow, 3 grand. We have a line of credit, 30K, hypothetically at 3.75%. We are gonna chunk about 66%, more or less. Okay, the actual number is gonna be this right here, $19,800. Our goal is to establish a life insurance policy using the bank's money while simultaneously creating wealth, building, growing that money that we leverage, and not lose any of our cash flow in the process of doing this. So here are some examples here. And for this, this whole part right here is really going to be reflecting right around this range. Okay, I'm gonna kind of display this one right here. Okay, this one's this is the most reasonable one, and then these are this is one I would say is conservative, and this one is like really aggressive, being aggressive with your insurance funding. Okay, so the first piece that we need to figure out is how much are we going to fund this supposedly life insurance policy, right? If we have the line of credit, you got your numbers down, okay, that's all clear. This number right here, 19,800, is basically half of what her cash flow is per year, right? So yearly cash flow is 36,000, half of that, give or take, and then I factored in the 2/3. Here's my sweet number. That's my sweet number, 19,800. That is what I'm going to tell the insurance agent, okay, or AKA me, that's helping you out. That's what I'm going to tell the insurance agent to design my policy. Okay, I want to put in, so what I want to put in, $19,800, okay? Based off that number is going to determine a couple of things. It's going to determine my insurance expense. It's going to determine my MEC limit. It's going to determine my death benefit. The way we can hypothetically put this together is some rules that I personally have when I help my clients design policies. Is I say, hey, listen, no matter how much money we decide to put in to a policy, I typically don't want the premium, okay, the cost of life insurance, because that's what we're doing. We're buying a life insurance policy, a permanent life insurance policy. I don't want my costs to be really over 25% of whatever I'm putting in. Okay, so 25% or less is what goes towards premium, and then the rest goes towards cash value, which is going to grow anywhere from 4 to 6.5%, or even upwards of 12.5%, completely tax-free if designed properly. If designed properly, got to throw that in there, right? Because sometimes we don't design these properly, and I have clients that say, oh yeah, I got that infinite banking thing, and then I look at it and I'm like, I don't know, man. Why is it taking you 10 years to break even on your policy, or 13 years or 15 years or whatever the case is? Like, why is there no cash value in the first year or two? What's going on? What's going on, right? And for most people, that's typical. But with the infinite banking concept, that is not typical. We want to have cash value in the first years. We want to have at least 70 to 80% like cash available, liquid. I'm able to use it. Take this number and you just times it by 25% or less, you're gonna get about the average of what your insurance costs would be. So you times that by 15%, boom. 25, boom. 20%, boom. A rule of thumb for me, for her, for this situation is, listen, I don't want your premium to be more than $5,000 a year. Okay, that's too much for what we make, right? It's too much. Now, if she was making double, right? If she was making triple, different story, right? Like I always say, case by case. Let's just work through it. That's the income. So I really don't want my expense to be more than that. Now that we got the insurance expense, we're going to go off that number, the $2,970. With life insurance, your MEC is determined by what your premiums are. Okay? So whatever your premium is, you can take that number, times it by 10, and you'll get a MEC. Okay? Now, depending on her health and age is going to be another factor in determining how high this MEC will be. So I wrote, worst case scenario, her MEC will be somewhere around 29,000 or a little bit higher. That's cool. I'm cool with that, right? And like I said, if it was, a 17% expense or 18% expense, whatever it is, it's going to be higher than that number. That's the lowest MEC that I'll submit to, right? Because this is her yearly cash flow. So in my head, I want to at least get in that much every single year into my policy. And I want to do that with the least amount of premium, right? So instead of telling the agent, hey, I have 36,000, that's my cash flow per year, putting in maybe 3,000 a month or something like that, no debt, no obligations, no nothing, right? 3,000 free cash flow, 36 a year. Okay, instead of telling the agent I want to put in 36,000, that would give us a much higher life insurance expense. Would you agree? Yeah. So that's why I cut it nearly in half, right? Just pretty much right in half, to then base off my insurance off that number. So now I have much less of an expense, and I still keep that MEC quite high so that I can get to that point of putting in 36,000 a year, or even more than that, right? 50 or 40, whatever the case may be. So we get through that point, right? That's the layout of the policy. 19,800 a year, MEC is 29K or higher. Now I want to go into the velocity banking. I want to go into velocity banking. How is this going to play out? All right. Now, in my mind, I'm going to recommend a Guardian life insurance policy. The reason why I say Guardian is very flexible on how we fund our policy. We can put money in at leisure at any time up to our MEC amount. No questions asked. Don't have to do any extra blood work or medical, nothing like that, right? I can even pay my premiums up for the whole year, and then put in extra cash at leisure. Here's how your financial picture is going to look like. So we've got our checking account, and this is me talking to my client right now. So just, kind of sit back and just kind of feel how I communicate with my clients when I'm talking to them over the phone. This is just me reiterating everything, laying it out in a picture format for them so that they know exactly what to do moving forward, right? And creating that life that we want. So for my woman here on the board, right, income comes into the checking account. On this side of the triangle, we have our line of credit, $30K, right? Before you pay your bills, we're going to determine what our chunk is, which we already did, $19,800, and we're going to establish that policy, okay? Money's going to go into two places, premiums, cash value. The premiums, boom, somewhere around that number. The cash value is going to be minus whatever my premium was, and I'm going to have earnings anywhere from 4 to 12.5%. Reason why I say 12.5% is with Guardian, we can explore the index participation rider where we can earn with the S&P 500, and even when the market doesn't perform, because we know that it will not perform some years, I'll still get my guaranteed floor of 4%. So I'm going to base off my earnings throughout this example off the 4% to see, worst case scenario, doing this strategy, will it cost me money, and can I recoup whatever that is? If I don't lose money, how much do I gain, and does it make sense? Is it reasonable to do this? Does it make sense? Because the goal is here, right? We want to become financially free, and now hypothetically we're 56 going on 57. So I want to make sure that I do not lose money when I either save money, invest money, or spend money. I don't want to lose money. I want to be constantly leveraging it because my time is limited. I don't have much time. So, we have this 5 to 10 year window to really create this, what shall be. This is what is, right? Creating all this. This is outside. This is what is, and this is what shall be. So if you speak that into the existence, you already know the good Lord is going to return exactly what you want and what you desire. He's going to give you what you want. But we got to create what is. We have to realize where we're at and build on it, okay? So we've got the checking account. Money goes in. Here's the line of credit. I make a withdrawal. of the $19,800 to the checking account. I pay the policy. Money gets divvied out, pays the premiums in full for the whole year, right? And now I have cash value growing immediately. Now, we have to remember, we now created a debt on the line of credit, and we're paying 3.75%, okay? Here's where velocity banking comes into place. We have this checking account with our income is coming in. $5K you're going to dump into a line of credit, and you're going to let it sit there, okay? It's going to drastically lower the balance, okay? Look what I did here. I displayed 19,800 times the 3.75% leaves us with a yearly cost of $742.50. Divide that by 365 days, we're looking at about $2.03 a day, times that by 30, $61 a month, right? How do I lower that number, right? Well, by doing velocity banking. Dump all your income into the line of credit. So 19.8 minus 5, boom, leaves us with 14.8. Do the same thing. You times it by the 3.75, you get the number, divided by 365, you get another number, boom, you're left with $45. Okay? So that's the first month, one month of doing this. From right here to right there. So looking anywhere from 45 to maybe $60 at max. Keep that in mind. Write that down. Keep that in mind. Cost on the line of credit for borrowing $19,800. No, I mean, this is negligible. This is nothing. Here's the interesting part. When I started this policy with Guardian, would you agree with me that day one, I can pull money out? I'm going to have, what, about 16,000? If I look at my notes, I'm going to have about 16,000, 15,000 in cash value day one of starting the policy. So here's where we combine velocity banking and infinite banking together. Instead of me taking out the 2,000 to pay my bills normally, right, like I normally would in a normal velocity banking method, instead of taking the $2,000 out of here, because that's option one. Option one is, look, we make a chunk into the policy, we do velocity banking. Money goes in, money comes out. That's it. You wait 4 to 6 months, you zero out the line of credit, you make your next chunk, boom, you hit your mech. Close to your mech, you're done, right? You're done within maybe like a 8 to 10 month period, and you've got 2 months left to really do whatever you want outside of this. I mean, you can look at real estate. I know you have a business and that's what you're trying to build, that entrepreneurship and spreading the gospel, spreading that word. I love it, so that we can focus and allocate time there while simultaneously doing this. Option two is, what if I took that chunk from the line of credit, started the policy, got it in force, money went to premiums, majority of it went to cash value, I'm earning money instantly, right? I start to earn money right away. And what if I took a policy loan out for $2,000 and deposited into my personal checking account to pay my bills, right? And whatever your assumed expenses are. Now, we're assuming your expenses are going to be $2,000 because we wiped out all those debt obligations we no longer have to worry about. So what if once a month we did a policy loan for $2,000? Now, I did some homework. I was looking online at, what is the Guardian interest rate, because those things change. You can go with with life insurance loans, the interest rate on a policy loan is the same calculated rate as a line of credit, simple interest, okay? So you're going to get charged simple interest on a policy loan. Even though they call it a loan, you would think amortized, but it's actually simple interest. There's a couple of things that they do really uniquely for senior citizens, like if you're 65 or older, or if you had the policy for 20 years or longer, that the interest rate on a policy loan is going to be 4%. If you're not 65 years old and if you have not had the policy for over 20 years, which is this situation right here, I believe the loan rate is 8%. That's the highest number that I saw. I could be wrong. I can assure you that the number is not going to be higher than 8%, okay? Because this is one of the 4 majors. So I know that the interest rate on a policy loan is not going to be more than 8% simple interest, okay? If it's less, great. If it's not, it's probably going to be this 8%. If it's that, we're basically highballing it. So we're going off to 8, all right? So here, let's do some math. If I take $2,000 out first month, doing the chunk to start the policy, and then I turn around, take $2,000 out, what's my interest rate cost daily going to be? Let's figure that out. Take the 8%, you times it by 2, you get $160 a year, divided by, wow, I put 360, it's really 365. And it's going to be somewhere around 50 cents a day cost, interest costs, right? Mind you, what are we doing? We're earning 4 to 12.5 in that range on 16,000. okay? Even though I pulled money out, the insurance company is still going to credit me on all my money. They're still going to credit me on all my money, even though I have this loan out. So what happened is the insurance company gave me their money, not my cash value. They gave me their money for $2,000, and this $2,000 is going to pay bills throughout the month. Meanwhile, I have this $5K sitting in the line of credit, and I don't even take money out of that. So all I have to worry about, my total cost indefinitely should be somewhere around $45 for the month. Because when I put that $5K in, I satisfy whatever the payment is on that line of credit. So I satisfy that, done. Don't need to worry about it. Matter of fact, I probably pushed the due date out a couple of months. I have this loan out for $2,000, which I don't need to pay anything towards the insurance company. That's another factor to remember, is when I take out a policy loan, I don't have to pay it back immediately. I can tell the company when I want to pay it back, and I'm gonna explain when we actually do that. So come back down here, month 2, right? Coming around, 30 days go by, whoop, right? Pay our bills, money went in, funded the policy, balance is at the 14.8. Next month, another $5K goes in, drops down to $9,800. Okay, $30 is what we're looking at. Total interest cost for the month. In that same month, what did I do? I took out another policy loan for $2,000. Okay, stay with me. Month 3, do it again. 5K goes in, brings the balance down to 48. There's my cost for the month, about $15. In that same month, I took out another policy loan for $2,000. Okay, did the same thing. Money went in, paid my bills, boom. Last month, I dumped $4,800. That's all I can put in out of the 5. Line of credit's at 0. Okay, and in that month, interest cost is negligible, really less than whatever that number is. Whatever that cost is for that previous month, it's going to be less than that by what? 0. Really going to pay nothing. With all that being said, that has been about 4 months. So let's add up our cost. Okay, you take that number, take this number, take that number, okay? Take this number here, you times that by 30 days, okay? And then whatever that number is, times it by 4 months, because we're going to take out 4 policy loans, 2,000, 2,000, 2,000, 2,000. I have the cash value available in there, right? I've got about 15 to 16 grand, so I'm not worried about that whatsoever. Plus, it's the company that's giving me their money. So let's look over here. I wrote out some stuff here. We've got about $13.15 a month, which is the cost of that, borrowing from the policy loan. All right, so that's what we're looking at a month. Let's say, just to be safe, because, people do things, goes on a vacation, different, whatever, everyone does their thing. Let's say conservatively, it takes me 6 months to pay back the line of credit so that I can make the next $19,000 chunk or whatever the chunk may be, right? If it took me that long, my cost, 6 months, 2 times 6, right? We would have taken out a total of $12,000 out of the policy. Our cost would be $473.42. If we're doing 2 chunks a year, right? Every 6 months, so that's 2 chunks a year. My total cost would be $946 over here on the policy. And you can do the same thing down here. You can take those 1, 2, 3 numbers, right? Or extend it like an additional 3 months. Capture that. Looking at this number right here, this is the hypothetical number that I would have in cash value, right? Which is really 19.8 minus this premium expense right here. Well, you take a cash value, you times it by the 4%, right? Remember I said I'm going to do worst case scenario. Times it by the 4, what do you get? 673.20. The second chunk, okay, the second time around, right, doing velocity banking, 19,800 times 4% gives me 792. Add those two numbers up. Year 1, doing velocity banking, infinite banking, I should get, worst case scenario, that amount, $1,465.20. Here's my cost here on the insurance side, $946 for the whole year. And I wrote down here $90.60 if it took me 3 months, right? Because that's, in actuality, if she actually followed this process and just put in the 5K, didn't touch it, borrowed what she needed. If she needed more than 2K, that's fine. We borrow what we need, and that money sits in there, keeps that interest rate low. We're going to look at somewhere around 90 bucks. You take that number, add it to that number. It's still less than what we're earning here. And I still have all my cash value, okay? I still have all my cash flow, right? Because I used the bank's money first, not her cash flow first. I used the bank's money first, and then I just paid myself back over here on the line of credit. Now, another factor that we can put into place here is she has a credit card. So when she borrows this 2K out of the policy, she can do it maybe halfway into the month or first 2 weeks into the month. She can take out that policy loan, right? And use a credit card to pay almost all of her expenses per month on a credit card. So we can use a credit card to pay all these bills right here. Because she doesn't have a car payment, doesn't have a mortgage payment anymore, doesn't have student loans, doesn't have personal loans, nothing that requires a debit or cash, right? So majority of her bills can be paid with a credit card. We're going to earn anywhere from 1 to 3% cash back. So let's do worst case scenario. Worst case scenario, like in the middle, maybe 1-2%, we'll get about $15 to $30 per month if we ran, if I did the math right, if we ran about $1,000. If I look at my notes, about $1,000 out of this expenses right here, 1,000, 1,500, whatever, about $30 per month, okay, or more, right? Because there's those credit cards where you can select the category where you want to earn 3% on all your stuff, or you can just do 1% on everything, right? So if you do 1% on everything, or 1.5% on everything like Capital One does, then we're going to earn anywhere from $15 to $30, right? Over 3 months, we can conservatively obtain about $90 in cashback rewards over a 3-month period. It's not hard to do. So we could offset the interest costs on the line of credit by using a credit card. And we also offset this money by the earnings that we get from the company themselves for putting in the $16,830, and then that second chunk, no, the first chunk was $19,800, but a portion of that went towards premiums, right? And then this other $19,800 earning 4%, total $1,465, all right? and we completely offset the line of credit. We offset what we put in. We're doing velocity banking. We're taking policy loans each and every month, little ones, not big ones, as we what? As we need it, just like we would a line of credit. Take the money out as we need it. So same thing with the policy, taking the money out as we need it. Here's what's so interesting is that we're literally creating our wealth from expenses, our day-to-day bills. So all we're doing on a simple scale here, all we're doing is just leveraging how we pay bills, right? That's all we're doing, is we're just switching up how we pay bills. We're letting the bank fund this tax-free bank, which is going to earn us money for as long as we live. We're going to get this guaranteed increasing death benefit that gets delivered to our heirs when we pass away. So that's the legacy portion right there. We're earning money, so we're creating this we're creating this big line of credit over the years while earning interest tax-free. So that's creating the wealth portion, getting us closer to this financial freedom part, right? And you figure if we do this for about, 3 to 5 years, in those 3 to 5 years, she would have built a business. She has me as a partner. I'm with her, right? Doing all these, I'm creating this whole series all about her, right? That's what it is at the end of the day. Can you help one person? All right, that's what I want you to really take away. If you don't take away anything from this video, or maybe you've already X'd out of it, because some people are like, oh my God, it's a headache. I can't, and I understand. That's why you hire a coach to do it for you, and then you lay out the numbers and you just follow it, right? Okay. So in this case, I think we just cracked the code. I'm really excited. I'm like, let's see, where are the cracks? Does anyone see cracks? If you see a crack in my strategy, please comment below. This is a learning opportunity. This is a learning phase. This is what we're doing together. I'm 23 years old. I got so much more to learn from everyone, from you that are watching me all the time. So you might as well get more engaged. Be like, nah, Denzel, I see a crack over here. I see a crack over here. Honestly, I'm not seeing any cracks. Maybe I'm really biased, so maybe you can help me out. But just to recap one more time, what did we do in a nutshell? We have a line of credit. We made a chunk. We started a policy. Money went into 2 places: premiums, cash value. Majority of my money went towards cash, started earning interest, this amount. Take that amount, minus it from the cost of premium. I make up for it. Now, we took money out. This is our cost. This 946, okay? Whether we took a loan out or not. So here's the other thing to be aware of, is if we were to take this same scenario and match it up to someone else that did not take policy loans out, our policy would perform the same way as theirs, even though they didn't take out any money. But see, that person that doesn't take out any money out of their policy, there's no use, right? So all you're doing is saving money. You're not doing anything with it, right? That's pointless, okay? So in this case, we're actually using the money to our advantage, saving tons of money on interest savings, building up our credit, building up our capital, okay? So we got the money that went into the policy. We took policy loans out once a month, each and every month, just to pay normal expenses, right? And it doesn't cost us anything to do so. Meanwhile, every time we make money, 5K, could be more, could be less, 5K sits in the line of credit. Hypothetically, it takes us 4 to 6 months to pay off the line of credit and do it again. If it takes us 4 months, then we get it done in about 8. That's why I wrote about an 8-month process to do this. We get the 2 chunks in to the policy, and we have 4 months to invest in a property, in a business, because this line of credit is going to be at 0, right? After 8 months. So she can let that policy sit and grow, right? Meanwhile, we can take this line of credit, or we can go get more credit lines and go acquire property, do the same thing. Option 2 is we can take money out of the policy and out of the line of credit and acquire more real estate, acquire more investment, and have those things, those investments, create cash flow. Where does it go? Sits in the line of credit, which then we chunk into the policy, which then we take out a policy loan to pay expenses, and we create this nice financial flow. Creating the financial flow so that we can get to the financial freedom, so that we can do some more praise work, so that we can do some more giving and receiving and some ministry and some guidance. We can save people, can have them be reborn. I mean, there's so many opportunities that we can create for ourselves. And mind you, remember, look how much money we make. 5K. Remember, we can always 10x. Imagine if she 10x'd her income and continued to do this, right? So I didn't even go over how to make money or how to invest money. All we're doing is managing what we already make and maximizing it to new heights, okay? This has been an extensive video. I hope I was detailed. If you think I missed out anything, comment below. I'll respond, okay? And we'll open it up to Q&A. Maybe I'll even do a live stream on this and kind of go over it and just keep pouring out to you guys. All right, this stuff gets me so excited. I really hope you enjoyed this whole series on velocity banking, infinite banking, put together to create financial freedom. Okay, my name is Denzel. God bless you. Have a wonderful day.